Hello, good evening, ladies and gentlemen. Welcome to the SmartFX webinar. It's good to be here with you guys today. My name is Nasir Mohammed, and I'm your host for this educational series. I want to welcome everyone from wherever you're joining us. Good evening to you in Kenya, South Africa. Good afternoon to you in Nigeria. Welcome to this educational series. Our goal here is to give you as much simplified information to help you move from newbie to professional trader in as short a period as possible. So I welcome you guys once again, and please follow me as I present to you the slides and try to give a detailed explanation on each of them. So before we proceed, I want to implore everyone to please follow us on all social media. You can find us on LinkedIn, Twitter, YouTube. We have some other videos there from other professionals on our team that could serve you. So please have a look at our YouTube and learn from there. Once again, my name is Nasir. Here's my mobile number, so feel free to hit me up directly. I'll give a brief about myself. I have been working in the financial market space for about 5 years, well over 5 years actually. I've worked as a broker, worked as an institutional trader, and right now I represent Africa basically as a regional manager in SmartFX for the African region. So the topics we'll be covering today is first, what is Forex? What is traded in the Forex market and how to trade Forex. So these are the key things we'll be talking about today. So just, I want you, before we proceed, that you keep in mind that this webinar series would not just be about Forex alone. It's actually designed to cover all financial markets, different asset classes. So a lot of the strategies and techniques we will be teaching you are things that would actually help you to trade even the stock market or the commodity markets. Everyone has different preferences, right? Some people say, I don't really like Forex market. Some people say the stock market is what does it for me. Either ways, whatever works for you is perfectly fine. So please follow us in this educational series. We will be hosting sessions every week, all for free, just to serve you. So as long as you keep following up, you would learn a lot, I can assure you. So we start with the Forex market, as I said. It's a massive financial market where fiat currencies are traded. Now, when I say massive, I'll give you a picture, an idea of how massive exactly. So it's estimated that over $5 trillion in volume is traded just on the Forex market alone across the world. So just imagine the number, $5 trillion in volume on a daily basis. I mean, when I first got into the market, the first thing that came to mind when I saw these numbers was, how do I get my share? You know, I mean, how can I get my share from $5 trillion in volume every day? You know, so this makes it the largest financial market. The stock market will be the next largest financial market, followed by the bonds and then the commodity markets. So as we go on, I would enlighten you more on the structures of each of these markets. Currencies are the name of the game, yeah? Yes, you can buy, you can sell against each other, short-term, long-term investments, or somewhere in between. You could also decide that your Tenure is more midterm. So we call that, maybe you decide to approach it with swing trading strategies. If you're taking a short-term approach, you might decide to be a day trader. If you're taking a long-term approach, then you might decide to be an investor, hold position for months or years, the likes of George Soros, Warren Buffett, and so on. The first thing that you need to know about Forex is that currencies are traded in pairs. You can't buy or sell um, without you can't buy or sell a currency without a counter currency. So I'll give you an example. Yeah. Back in the days when the world was still operating on a trade by barter system, I mean, if you have coffee, for instance, and you wanted shoes, what you need to do is you go to the marketplace, you exchange your coffee for shoes, right? You exchange your coffee for shoes. Same thing applies in the Forex market. If you want US dollars and you have your local currencies, shillings, naira, rand, whatever it is that you have, what you need to do is you go exchange that for whatever other currency you want, US dollars, for example. For those of us that come from, I think, East Africa, yeah, West Africa, I think South Africa as well, we have the system that's called the BDC, which is the Bureau de Change system. And the Bureau de Change system is simply an exchange system where you can physically exchange your local currencies for international currencies. So let's say you're traveling to Dubai, for instance, and you need US dollars because you obviously cannot spend shillings or naira or rand in Dubai. You go to these BDC exchanges, you give them your naira, and then they give you dollars. This is exactly the same scenario when you trade the Forex market. The only difference is in the Forex market, you are doing it the 21st century way, which means that you're doing it all online. You don't physically need to go into a shop or go to your broker or whatever. No, everything is done online on exchange platforms. By one click of a button, you can buy and sell different currencies. So some of the ways through which you can gain access to this markets and be able to trade different currency pairs is through the spot market or the futures market. The spot market basically means that you're buying or selling instantaneously. By one click of the button, you exchange your US dollar for Japanese yen, While the futures market is basically you're trading the futures in the future value. You're not trading the markets right now. You're basically saying you want to buy a certain amount at a certain rate sometime in the future. So mostly people like to trade on the spot market. Now, this also brings me to the biggest players in the spot in the Forex market. As I previously mentioned, it's a huge, unimaginably huge market, right? We're talking over $5 trillion in volume daily. The biggest players here are the central banks, number one. So central banks basically have to undergo routines, monetary policy, fiscal policy moves to stabilize the rates of their currencies. So the central bank is usually the biggest player, followed by the big banks, international banks, the JP Morgans, Goldman Sachs, HSBCs, and the likes. These guys also play big in the Forex market. Next up, you have huge corporations, multinationals. Let's take Apple, for instance. Apple is a huge multinational, constantly importing, selling, buying from different parts of the world, right? They need to make settlements for a lot of these trades in various currencies. So Apple, traditionally being an American company, could have dollars, but they need to pay some of their imports in China. So they need to convert some of those dollars and settle in yuan. So in this way, they have to come to the Forex market to exchange a lot of to exchange value for the currencies. So we move over to types of analysis. The red pill, the green pill, the blue pill. What's it going to be? Which one are we going to pick? So I'll just give a brief explanation of each of this. First, we have the most popular, which is technical analysis. This is basically where traders get to study price movement on charts. I mean, I'm sure many of us must have seen some samples of these charts, whether in the movies or wherever. If you've ever visited a stock exchange floor, you would see a lot of stock charts. So technical analysis basically is the mastery of reading price charts, understanding recurring patterns, and based off of that, you use the information you get from these charts to make future decisions as regards what to buy or what to sell. If you're the kind of person who instead prefers to analyze social events, economic events, political events, that could affect supply and demand, then fundamental analysis is for you. So, I mean, I'm sure we're all familiar with the ongoing issues with Russia and Ukraine. If you're a person who likes to sit and if you have an analytical mind to sit and analyze situations like that, then you can look and say, okay, Russia is attacking Ukraine, right? What's the effect likely to be in the financial markets? Gold, should I buy gold? Should I buy the yen? Should I buy, you make decisions off of these happenings in the world. That's what we call financial markets. And the blue pill finally, which is sentiment, market analysis of market sentiment. And I like to say that this is basically a combination of technical and fundamental analysis because it simply points to you trying to understand not just what's happening in the economy, not just what's happening on the charts, but you're trying to understand what majority of the market participants are doing. All of the people who have taken in fundamental information, all of the people who have taken technical information, they combine and then make decisions based on individual perspectives. And all of these things is a combination of those factors is what we call market sentiment. So right here, we have a sample chart. This is just to show you a sketchy example of what a price chart looks like. So for the technical analyst, this is a sample of what you would see on the price chart. This can be customizable in many different ways, but I mean, we would get to sessions where we'll teach you in-depth analysis on how to look at these charts, how to customize them, how to understand them. So the next thing is, how do you know when to buy or sell a currency? So as stated previously, your decision to buy or sell would basically be based off of whether technicals, fundamentals, or market sentiment. Whatever you choose, there's no right or wrong answer. You have to keep in mind there's no right or wrong way to look at the market. You basically have to just choose what works for you, right? So the supply and demand for a currency changes due to economic factors, which drives currency exchange rates up and down. Each currency belongs to a country or region. So Forex fundamental analysis basically focuses on the overall state of the country, the economy, such as productivity, employment, manufacturing, international trade, and interest rates. Interest rates, guys, interest rates, very, very important part of the analysis process. I mean, even if you're simply a technical trader, you will definitely, I mean, once you grow in your journey, interest rate is one of those things that you definitely have to pay attention to because it's the key fundamental driver of every currency. And as I previously stated, the central banks are the biggest players in the Forex market. And one of the key tools which they use to regulate the value of their currency is the interest rate. So in order not to complicate things right now, we would get into further details about interest rates in one of our next episodes in the series. Now, getting to the more integral stuff. Here we have an example of what a currency pair looks like, Euro USD. Now, when you look at the Euro USD pair, the base currency here, which is the basis for you buying or selling any currency pair. So the base currency is the first pair you can see in this cross. So looking at this, we have Euro USD. Euro in this situation is the base currency. And then if you believe that the US economy will continue to weaken, which is bad for the US dollar, you would execute a buy Euro USD order. So what this simply means is you have a Euro USD pair. In summary, the job of every Forex trader is basically to take in information and try to understand or decide which currency is likely to appreciate in value against which currency is likely to fall in value. So in this example, if you think that the euro is likely to appreciate in value while the dollar is likely to drop in value, then you buy the euro USD pair. If you think that the converse is the case, where you think the dollar is likely to appreciate in value and the euro is likely to drop in value, then you have to sell the euro USD pair. And by doing so, you have bought euros with the expectation that it would rise versus the dollar. Exactly. So we'll take one more example, which is the USD JPY pair. And in this case, which is the base currency, as you guessed, it's the US dollar because it comes first in the pair, while the Japanese yen is the other side of it. So if you're buying the USD JPY, it simply means that you're expecting the value of the US dollar to go higher, to appreciate against the value of the yen. So this is a brief example of how you buy and sell pairs in the Forex market. And I mean, these are just two examples. There's so many different pairs to sell. You can match differently. You can buy the Japanese yen against the Swiss franc, the dollar against the yuan, the British pound against the South African rand, so you have many different pairs, all of which we would show you how to trade on as the series progresses. So please ensure that you continue to tune into our weekly webinars to get a lot of this information. So getting into more of the integral stuff here, where we'll be looking at trading in lots. When you go to the grocery store, I mean, you don't buy one single egg, right? This eggs will be sold in a bundle, probably in a dozen of, in a pack of 12 or in a pack of 6, Same thing goes with trading the Forex market. You don't go buy €1, instead you buy in a bundle. So lots basically refers to this bundle. When you buy, the lot size is basically the units you are choosing to buy or sell. So that's what lot size mean. And the degree of lot size or the amount of lot size you can use, there's so many factors that can determine this. One is the capital base you have, how much money you have in your account. Another is how much margin you have to trade with, and then the leverage you have to trade with. We'll look at margin and leverage next. I mean, a lot of people would imagine that I don't have $10,000 to trade, or I don't have so much money to invest in the Forex market. How can I get involved? The good news is you actually do not need $10,000. You do not need excessive amounts to be able to make money in the Forex market. And that's because of margin trading, basically. So trading in margin. So trading in margin is basically like a loan that your broker gives you. And it mostly applies to retail clients. And this just gives the retail clients the opportunity to be able to trade large, like banks and other institutions. So as I said, the margin is like a loan granted to you by your broker, such that you do not need to put down a huge amount respective to the amount you intend to trade. Margin works hand in hand with leverage. Basically, you get to set up your leverage when you're creating your Forex account with your broker and determine the amount of leverage which you would want to use on setting up your account. And here we give an example of what leverage could look like. So we said, for example, 50-to-1 leverage. This simply means you're using a 2% margin requirement. So if you have $2,000, you can trade like you have $100,000 when you use 50-to-1 leverage. So, I mean, just imagine how mind-blowing that is. You only have $2,000, but you can make money like you have $100,000. Sounds very interesting, I'm sure. But there's a but. You have to know that leverage being one of the most attractive things that brings people into the Forex market also happens to be one of the biggest reasons why you have to be very careful. Because what leverage does is it maximizes the potential for reward, but also maximizes your risk. So the professional way to deal is to be able to manage your downside. As long as you can cover your risk, you can manage your downside, you can manage your risk properly, then you will be fine. Next up, we look at pips. What is a pip? The pip value basically is the value of movement. The value of one tick movement on a Forex chart or a Forex pair is called a pip value. Now, if you look at this image, here, you can see the sell and the buy on the Euro USD. So this is just for example sake only. You have the dollar, the euros trading at 1.13582 the pound to the US dollar. The euro trading at this to the US dollar, right? Now, one pip, basically, if you look at the figures here, you have 1.13. The 52 here represents 52 pips. And then the difference between the sell and the buy represents the spread. Well, we'll go shortly into what spread means now. So the next question is, what is spread in Forex trading? typically Forex brokers would quote two prices, the bid price and the ask price. The bid price is the price at which you sell the base currency, while the ask price is the price at which you buy the base currency. Now, the difference between the bid and the ask is what we call the spread. The spread is how your broker makes money. So again, for example's sake, if a merchant who sells clothes or food items or electronics or whatever, let's say you buy goods worth of $1,000, your cost is $1,000, right? And then you go on to sell those goods for $1,100. You've made $100 profit. Now you made that profit by buying at $1,000 and selling at $1,100. So the difference between the amount you actually bought and the amount you actually sold is what we call the spread. I mean, yeah, typically that's called a profit in everyday business, but here in the Forex market, we call it the spread, and that's where brokers make money from. And it's usually very minimal. So one of the advantages of trading with SmartFX as well is that we charge very minimal spreads compared to most other brokers. So next up, we're looking at how to actually place trades in the markets. There are many different ways to skin a cat, as they usually say, as the quote goes. And here in the Forex market, there are two ways. First, you can use the market order, which is by far the most popular way that people take trades in the market. And then we have the pending order. The market order simply means that you instantly execute a trade. So you want to buy the euro versus the dollar, for instance. You simply just go to your platform, click a button, you buy. Or you want to sell the USD, the dollar versus the yen, you simply go to your platform, you click on sell, and that's it. That's what you call a market order. However, when it comes to pending orders usually is a system where you do not want to execute at current market price. You want to either buy when prices fall to a lower level. You expect that prices would fall to a lower level, so you want to buy from this lower level in anticipation of a price rally, or you expect that prices would fall, but first they would rise to a certain level, and then you want to execute a sell order at a higher level. You can do that as well. So the first example I gave is a buy limit, where yes, I expect that the euro dollar is going to continue going higher, right? But I still feel like it's going to first fall in value before it goes higher. What to do? What do I do? Rather than buy now and allow that trade to go negative against me for a while, I'll rather place a buy limit order with the intention that when price hits this floor, then it executes my trade and then goes higher. The good part about this is all of the process is automated on the platforms which we will be providing you. So I'll give an example in numbers. Let's say I want to buy Euro USD and it's currently trading at 1.100. But I feel like the value is going to drop first to 1.0 before it goes all the way to 1.5. So I could place a buy limit at 1.0. So when price falls to 1.0, it triggers my trade and then could go all the way to 1.5. That's one way to do it. Another way to do it is, let's say I'm looking at a sell limit where price of Euro US is currently at 1.5, for instance. but I expect that price is going to fall to 1.0, right? But first it might get to 1.7 before it falls to 1.0. So I place a sell limit at 1.7 with the expectation that when price gets to that point, it triggers me and then it starts to fall. So that's what we call a sell limit. We also have the buy stop and the sell stop, which is kind of like the opposite of the buy limit and the sell limit. What happens in the buy stop is I expect price to go from, let's say, 1.0 all the way to 1.5, but I'm not 100% confident, right? So first, I want to see price get to a certain level, then I can be more confident that it's going high. So if price is currently trading at, say, 1.0, I might decide that I place a buy stop at 1.2. And then when price gets to 1.2, it triggers my trade and goes all the way to 1.5. That's a buy stop. Conversely, a sell stop is when I expect that price is going to fall, but I'm not 100% confident, for instance, that it's going to keep falling from where we are right now. So if price is at 1.5 currently, and I expect it to go to 1.0, but first, I'm seeking further confirmation that price would actually drop all the way to 1.0. I could decide to set a sell stop at 1.2 or 1.3. So when price falls to 1.3, it picks up my order and goes all the way to 1.0. So this is what buy and sell stops are, and as well as market orders. Next up, we have trading sessions. Now, one of the fundamental characteristics of the Forex market is the fact that it's open 24/5. That's 24 hours, 5 days a week. The market is open. And this is only possible because of the switching time frames, the switching time zones, rather, from New York to London to Tokyo to Sydney, Australia. So when one market is closing, another market is opening. And that way, the Forex market is constantly open, 24 hours, 5 days a week. The reason it's not open on weekends as well is because the banks are the ones who make the settlement of this Forex trades, and the banks are not open on the weekends. So this is why we have 24/5 trading sessions. However, just because the market is open 24 hours a day doesn't necessarily mean that you can trade every hour of the day. One of the things that makes a professional trader is understanding the best times to trade, knowing when to trade, and knowing when not to trade. These are some of the key things that would set you apart in your journey to becoming a master trader. So here we have some details about the different time zones. The Sydney market opens at 9 p.m. UTC. The UTC is the same as GMT. So for in Nigeria, we work with GMT +1. In Kenya, we work with GMT +3. In South Africa, we work with GMT +2. So for instance, the Sydney opens at 9 p.m. GMT. GMT is the same as UTC. So if that means that in Nigeria, it would be 10 p.m. In South Africa, it will be 11 p.m. And in Kenya, it will be 12 p.m. So same goes for the Tokyo Open, the London Open, and the New York Open. These are the major market sessions we have in the world. So next thing is, what is support and resistance? This is actually something a little more advanced than everything we've been speaking about, because When we're going to support and resistance, we're going into more practical ways of analyzing the market. But we've decided to just give a brief touch on this, just to give some insight into some of the information you'll be learning in later classes when we start out on technical analysis. If you remember, we previously mentioned technical analysis is one of the key ways to analyze the markets. So, as it has been stated here, support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have the idea of how you should measure support and resistance. As this diagram shows, you can see that very clearly, you can see how price is flowing in the upward direction, falls down for a little bit, and then stops and then goes higher again. So basically, I like to look at resistance as a price roof. If the price of Euro USD is going higher, for instance, price never goes in one straight direction. That's another thing you need to understand. So if the price of the Euro USD is going higher, when it hits a price roof or a price ceiling, it then falls down, falls for a little bit, drops to a certain level, hits a price base, and then continues higher. So the ceiling where it hits, stops, and reverses lower, that ceiling is called a resistant level. And then when it falls down, hits a floor, basically, and then starts to go back up, that floor is called a support level. So the resistance level indicates where there is a surplus of sellers, while a support level indicates where there is a surplus of buyers. So based on these structures, market would ebb and flow. As I said, this is just a brief introduction to the concept of support and resistance, and in ensuing classes, we'll go deeper into how to actually apply support and resistance to our everyday analysis. Now, we're coming to the conclusion of the session, and I will just give an overview. I mean, after all said and done, why would I want to be involved in the Forex market? I'm sure a lot of you are asking yourself this question. The first one, and I think this would resonate with a lot of people, is the fact that it gives you the freedom to work from anywhere in the world at any time, any location. As long as you have a laptop, you have internet, and you have the skill set, then you can work anywhere. 2, it gives you the ability to be your own boss. 3, low capital base requirements. As previously mentioned, the use of margin and leverage has made it very easy for people to get involved in this market and be able to earn on their own. Next, you have very low requirements to entry. All you need is a laptop, internet, and most importantly, the skill set. The skill set is what we're here to serve you on the platter of gold, all for free. Next, you have the ability, the Forex market gives you the ability to earn in dollars, not just dollars. You could choose to earn in pounds, you could choose to earn in euros, in whatever foreign currency you choose. And then it gives you unlimited potential for personal growth and earnings. So the better your skill set, the more the potential for earning for you. Now, that being said, I would also like to give you a brief on the SmartFX advantage. So SmartFX is a broker, and we have been in business operating in Dubai for over 7 years. So our team boasts of over 20 years of experience, combined experience in the industry. So you best believe that you'll be getting best service from us. Also, we are putting best effort into creating free educational content via these webinars, which we would have weekly, via our YouTube channels, via our Instagram. You can find us on all over different social media channels. We provide daily signals as well. So, I mean, while you're learning, you can also earn. That's a fantastic way to grow. It helps you not just learn in theory, but learn in practical terms as well. You also get daily market information regarding interesting developments across all financial markets, whether stocks, whether Forex, whether commodities like gold, crude oil, silver. We will give up-to-date analysis on a lot of these interesting happenings in the market. So that's it from me for today. I hope that you guys learned a thing or two, and I hope to see you guys in the next sessions we'll be having. As stated at the beginning of this, I mentioned that this is basically an introductory class. So everything we have touched on today is just scratching the surface, introducing you to what the Forex market really is about, how you can make money, how you can get involved in this space, and how we are willing to hold your hand through the process. Our goal is to simplify the entire process for you as much as possible. And yes, please feel free to reach us directly if you have any questions. A lot of you have my direct line, so feel free to reach me directly via WhatsApp, and I'll be very happy to help you through your journey. Thank you very much, and I hope to see you guys in the next webinar. Take care. Cheers. Bye.